Our next speaker is Kris James Mitchener.
All right, thank you, Barry, and the other organizers for inviting me to this esteemed panel with my colleagues, Hugh and Dick. Let me try to take a slightly different approach, maybe echoing some of the same comments Hugh and Dick have made, but trying to put a little more flesh on the bones, so to speak. Starting with the comments Barry made earlier about what is the structure. So I just want to give you a brief overview because there's actually a proposal on the table here. It's less amorphous than political union. So let me just talk to that point quickly. So what will it include? Who will it be for? And then I'll talk about why now, which I think is an important question if you start thinking about institutional change, which this is really a discussion of. And finally, whether we can draw any parallels or any lessons from history. Okay, so on the first point, what do we have? What's on the table here? There are going to be three elements of the European banking union. First, the single supervisory mechanism. So you'll have a chief supervisor supervising the largest banks in Europe, those that are either a fifth of the country's GDP or 30 billion more of assets. So that puts about 600 of the 2,000 banks in the Eurozone under the direct supervision of the ECB. However, then the ECB will work with the European Banking Authority to coordinate, presumably to share information regarding the other 5,800 banks. So what does this mean? More French banks, fewer German banks, given the differences in the structures of the economies, and an ECB with authority to shut down banks not complying with the rules. Okay, so this is going to go into effect March 2014. The other two elements are at this point just proposals, and this is where really a lot of the political economy issues are maybe a bit challenging. So first is a joint deposit guarantee system. The idea here is if you have an asset price bubble, an economic downturn, these sorts of things, it can lead to what we saw in Spain and Ireland. You have nationally run deposit insurance systems running out of money, and if that's the case, then this can then spill over to the sovereign itself, and then that presupposes the third institution, which is a joint resolution mechanism, a new backstop, a single independent resolution authority. Okay, so for whom is this? Primarily the Eurozone, but the other members of the non-Eurozone EU can opt in, and there's a provision for double majority voting, which could suggest some kind of a two-speed Europe approach. Due to the interest of time, I'll try to be brief here, but I think the institutional structure here is quite important, and I think there are different policies on the table. So the big debate is whether, to some extent, it should all be housed in the ECB, or whether there should be other institutions. So the arguments for this are that there's of course the ECB is expected to act as the lender of last resort. If it lacks supervisory authority and detailed information about the banks, like we saw in the crisis, this can create problems. If it can't declare which banks are solvent and which are not, if it doesn't have a joint the authority to declare this, then it's going to be difficult to carry out the resolution, and it needs a backstop in order to identify the weak banks. So those are the arguments for. The arguments against are that there can be obvious conflicts in terms of monetary and micro-stability goals. So what do we learn? Where are we going with this? I think in some sense, when we look back at history, we know less than we'd like about the development of institutions. We can see this in the EU's own history, in particular how we sequence these institutions. So it seems to me, we liberalize borders, we liberalize trade, then we liberalize capital flows, and so let's liberalize banking. But we don't really think through the consequences of that sequencing, and we could look to transition economies too and say, well, what did we actually know about institution building with transition economies? So we'll look back at history, I think, in some sense to see, to paraphrase the 1190 saying from France, Rome wasn't built in a day. And I think when we look back at the lessons from U.S. history in particular, that's really what we see. So the reasons why I think the U.S. is an interesting place to look for parallels, at least, is, there's the obvious element of political union with considerable state independence. As Hugh and Dick both alluded to, each state gradually developed its own regulatory and supervisory system over time, and those systems had a legal right to exist. And it's important to realize that that is part of the structure that's going forward with the current proposal on the table for the banking union in Europe. They will now eliminate entirely the supervisors at the national level. Moreover, I think the political economy issues here about how the existing institutions mesh with the new pan-European institutions, or in the case of the U.S., the union institutions, is at stake. Okay, so to understand the question why now, of course, I think that there are a couple different motives for institutional change. One is maybe Europe put the cart ahead of the horse in that they were encouraging banking market integration largely on the notion that this would have benefits to consumers, that there were benefits to increased competition. Okay, but what that did was it accelerated the gap between institutions and practices. So you get a large growth in cross-border banking in response to the single market. And so I have some statistics up here suggesting that 46 systemically important banking groups account for about 68% of EU banking assets, and that's from ECB statistics. So you've got integration changing the banking landscape and making institutional reform more salient. And so here's just some statistics looking across countries from Pisani Ferry and Sapir. You can see that the continental European countries have substantially have a very large share of assets outside their own jurisdictions. Okay, so why is this important? This is important because the existing institutions are, of course, all at the national level. And so you've got this notion that we can subsist with decentralization and cooperation. Okay, so this could be problematic, at least in the eyes of some policymakers and economists, if there's some incompatibility. So one theory out there is by Schoenmaker and Osterloo. They suggest that market integration, financial stability, and independent national supervision are incompatible. And so in their eyes, this is where the institutional change would come from. Okay. So now how does that look in contrast to the US? Well, in the US, the process of bank supervision emerges through a long process of trial and error, not overnight. And in part, this is because, as Hugh and others have written, capital market integration is a slow process. So that even by the end of the 19th century, more than 120 years after political union, there are still restrictions on branching which limits cross-border banking, and banks are primarily serving local customers. We have this fractionalized unit banking system. So as a result, you don't have the financial trilemma that maybe Europe faces, and supervision can evolve with the increasing sophistication and integration of the banking system. Okay, so that's maybe an interesting fact about things. All right, what do we know about what we think of as supervision? So this is an area of current research for me, and surprisingly, it turns out that modern supervisory practices, that is to say concerns about financial stability, about burdens to taxpayers or to depositors, this was not the reason why U.S. began to supervise its financial institutions. In fact, it goes back to Dick and Hugh's comments that the concern was over the authority they were giving away to monopolistic bankers through the issuance of these legislative charters. And so the concern was that you were effectively creating local monopolists. And so it was, again, parallel to Europe, it was about competition, not about systemic stability. And so concerns over depositor welfare take a long time to emerge. It's only after you get later into the 19th century. And so there are a couple features I'll highlight, a couple here and one more later. First, there was a change in the composition of the balance sheets of the banks. And so state chartered commercial banks shift their liabilities from notes to deposits. And this happens in part, as was alluded to, the note issuance of these state banks start getting taxed. So the financial innovation here is demand deposits, and that in turn derives the regulatory change or supervisory change. Second, the OCC, the Office of the Comptroller of Currency, comes online in the 1860s, and so you get regulatory competition. You get banks enabling themselves to choose either a federal charter, new banks, or to go with the state authorities. Okay, so the blending of these new pan-Euro institutions we're talking about with national regulators is kind of a halfway process. And I'm not sure that the U.S. experience here suggests this is the best way to go. So whereas the OCC did provide a model for establishing best practices, some states were free riding off this, and they just chose to delay developing their own supervisory institutions. So to what extent, if we have a lion's share of banks outside the supervisory authority of the ECB, suppose, then what are these other banks what are these other national institutions are going to do? Are they going to sit there and assume that the ECB will do its job as a supervisor, or will they continue to innovate? Moreover, the dual banking structure's incentive problems persisted through the next two big waves of crises, the 1907 banking panics, and then, of course, the 1930s. And some of my other research suggests that this led to effectively, there were poor quality supervised states, and they had higher failure rates during the Great Depression. So some of these issues around political capture we see in the data then, and they're with us today when we think about that the supervisor must be able and willing to stand up to politicians today. So those kinds of political capture are certainly an element of Europe today. The second reason, of course, for change is the crisis. So many commentators in the Eurozone had warned that there were insufficient institutions to deal with a financial crisis, but I think the exuberance of the day carried things. So it was kind of the no crisis, no problem mantra was trotted out. And then, of course, now we're in a crisis in Europe, and there's an interest in breaking this doomsday link between sovereign debt and banking. And so the argument here is that's necessary to shore up banking and sovereign debt simultaneously. But again, I'll remind you, you're doing long-term institution building in the midst of a crisis. So how well does that work out when you do long-term institution building in the midst of a crisis? Well, in the U.S.'s case, there's lots of examples at the federal level where we've done just this. Certainly during the Great Depression, we set up a joint resolution mechanism in the form of the Resolution Finance Corporation. We introduced deposit insurance, which could, at the federal level, we had the Banking Acts separating commercial and investment banks, and in 1907 we have the creation of the Fed. At the state level, what we see is some new evidence suggesting that the panics, and so this is just from a very recent working paper of mine, where the blue line kind of in the center there shows that around the panics of the 1830s, the 1850s, 1870s, and then 1907, you see considerable change in the supervisory institutions. So this is actually formal institutions. This is setting up state banking departments. And so this is where I come to the belief that changes in these institutions, at least historically, has occurred very slowly. Okay, so that's one aspect of what we can think about, formal changes to institutions. In terms of the joint resolution mechanism, here I think there's obvious pressure on the individual states to save failing banks, but then you run up bills that eventually overwhelm the states. And so the idea is we need to break that banking sovereign doomsday link. But the problem, of course, is what came up in the first session, which is how do you mutualize debt among Eurozone members? And here I think it's largely a political economy question. The resistance from certain member states. I think the finance minister of Germany just this week was saying, are we going to have to modify the treaties in order to put in a joint resolution mechanism? And then I think, to support Randy a little bit, not about the parties, but I think that there are questions of legitimacy here in the eyes of the voters. And I think that was the undercurrent of his comment in my mind, and that we're stuck in this legitimacy vortex. And then others alluded to the current electoral politics may block progress on this. So all this is to say that I think it's going to take time to come up with this. And that, again, doesn't necessarily bode well, because what's the halfway house in the interim if politics block it? Okay, now again, we can turn to the experience by states here, and we can think about the state process with debt mutualization. Many people have talked about Hamilton's ability to kind of blend U.S. long-term debt with state debts, U.S. debt with state debts, and then issued new long-term debt with a sinking fund and amortization provisions that were tied to the taxes, like alcohol taxes and other levies. But there are other experiences as well with crisis resolution at the political level. And importantly, there was a construction boom, a railroad and canal boom of the 1840s. that was financed through the issuance of state debts. So you can think of this housing boom financed through the issuance of lots of assets. And that the banks in these states held those bonds. So those banks holding those bonds had higher losses during the period than in the non-default states. So during this process of this construction boom, 9 states default, and 5 of those states repudiate their debts. So here you can see some cycle between bank distress and default. And what's really interesting is that the federal government does not assume the defaulted debt. Okay, so in the first case, in the Hamilton case, it does. In this case, it says no, we're not assuming it. Okay, so what does that speak to in terms of the political economy of over-indebted states? Well, it doesn't really get resolved at the federal level. I mean, some might say it does, that there was that the resolution is that it was done once and we're never doing it again. That could be one interpretation, but I'm not so sure. John Wallace, who will speak later, has a wonderful piece pointing to the fact that there were institutional changes, that states rewrote constitutions requiring the governments of those states to raise taxes before they borrowed. And they made those taxes irrevocable until the debt had been repaid. However, he and I would probably both agree that those kinds of constraints may not be sufficient, and that you may need some kind of central fiscal authority that could potentially use the threat of withholding transfers, and this gets to the other panels, and we can come back to this, to induce repayment. And so that assumes that the transfers themselves, of course, are large enough, which clearly isn't the current case. Okay, so the last piece, and I'm probably out of time, but the last piece I wanted to turn to was deposit insurance as a buffer. And here the belief is that there are significant benefits at the union level. As I alluded to before, we can overrun national deposit insurance systems as they currently exist, and then of course we have Cyprus lurking there in the background as a now useful case in that point. Moreover, I think getting to the incentive issues here, it's about bailing in financial institutions. So I think everyone wants some kind of levy to be assessed based on the riskiness of the portfolios, and then the notion is that you broaden the risk pool given the market integration. So the U.S. struggled with this for quite some time. Again, the evolution wasn't overnight. States experimented with it prior to 1861. There were 6 that tried it. Another 8 adopted between 1908 and 1917. All these experiments eventually fail, but they're useful. What do? They lead to lots of legislative action. More than 150 proposals are submitted to the U.S. Congress between 1886 and 1933 for federal deposit insurance. And so FDIC comes about during the Great Depression, but it too continues to evolve. It's not static, and so we see its authority really based on the quality of its supervisory institutions and the backstop it does have, at the end of the day, the full faith and credit of the U.S. government, even with these risk-weighted insurance premiums. So why don't you go 2 slides ahead. What are the lessons here? I think we can look to some of the earlier attempts at creating state-level insurance systems and see these incentive problems existing. So the safety funds that were these systems where banks were required to pay in a % of their capital into a state fund. They paid out creditors in the event of failures, but the issue here was that ultimately you needed the banks themselves to supervise the other member banks. And that was left to the supervisory institutions, but as I just showed you, those were pretty weak for a pretty long period of time. So the lesson here is you can't really ignore the interaction between deposit insurance and supervisory institutions. And so as Europe looks towards reforming this, they're going to have to think carefully about any kind of mutual guarantee system they put in place such that it has sufficient skin in the game and oversight. So that's what they did with the other types of institutions in the pre-1861 setup, that individual banks had power to control or modify the risk-taking behavior of other banks in the system. And so Weber's evidence suggests that these kinds of systems were more successful. So I will stop there. Thanks.